In this video, we'll talk about the basics of accounting for long-lived assets. First, I'll define long-lived assets. We'll talk about depreciation expense, and that's for finite-lived assets in particular. We'll talk about how accountants impair long-lived assets. And finally, if a company disposes of their long-lived assets, how should we account for that? First, the definition of a long-lived asset. It could be a tangible or intangible asset. Tangible means, you can touch it. Intangible means you can't really touch it, okay? So it's like a patent or a customer list or goodwill, which is a particular type of infinite-lived asset. So it could be tangible or intangible. But what is required is that the asset is expected to provide material economic benefit. So is the company going to benefit materially? There's the key word, materially, and that's a judgment call. Is it going to be a material economic benefit to the company for at least 1 year? So that's what we mean by long-lived, is that it's at least 1 year worth of use out of this asset. Okay, that's the definition of a long-lived asset. So now let's bring it into a specific example. And the example is going to be a treadmill desk, okay? A treadmill desk that sells for $350. So when a company buys one of these treadmill desks for its employees, it spends $350, okay? And it has to ask itself, does this meet the definition of a long-lived asset? So is its useful life, first question, is its useful life greater than a year? That's what we mean by long-lived asset. And I think it's fair to say yes, the treadmill desk will last longer than a year. So let's just say check, okay? Second, is the cost material? Okay, so this is getting at material. Is this cost, $350, is that material to the company? And here is where companies set their own policies. So what is material to your company might be different from what is material to someone else's company. So here in this blank, I'm going to set a company policy. Let's say if it costs more than $100, that's material to our company, okay? So in this treadmill desk case, the answer is yes. The treadmill desk is going to last longer than a year, and it's material because it's greater than $100. So we're going to capitalize this treadmill desk as a long-lived asset. And here's how we do that. We debit the PP&E account, property, plant, and equipment, which is an asset account on the balance sheet for $350. And assuming we're paying cash, we'll credit the cash account for $350. So there's the journal entry when we acquire this desk. Now the question is, okay, its useful life is greater than a year. Is its useful life infinite or is it finite? Okay, so we'll talk about life. Let's talk about the life of this treadmill desk. Is it finite or is it infinite? Well, I can guarantee you that this treadmill desk is going to go up in smoke at some point in its life, okay? So this treadmill desk is a finite-lived asset. Infinite-lived assets, there are certain infinite-lived assets which we'll talk about in different lectures and videos. The distinction here for accounting purposes is, should we depreciate this asset on the income statement or should we just leave its asset value as is? And if it's a finite-lived asset, we're going to depreciate the value of this asset over time. So you're going to see its balance sheet value go down over time, and we're going to have depreciation expense reducing our net income in each period. If it's an infinite-lived asset, if this thing's going to last forever, why would I ever reduce its value, right? It's going to produce value for us forever. So if that were the case, then we just wouldn't even record depreciation expense on this asset. It would just stay at $350 on our balance sheet forever. But here, this is the scenario we are in. We're in a finite-lived asset, and so we'll depreciate it. Here's how we'll depreciate it. There are different depreciation methods that we can use to reduce the value of this asset over time and recognize that as expense in our income statement. And I'll kind of teach you the idea behind 3 of these. The one we're going to learn and talk about mostly is straight line depreciation. That's the most common depreciation methods that companies use. And you can think of this in a plot. So let's say our balance sheet value is at $350, okay? The idea is that this treadmill desk loses value over time, okay? So it loses value and it's got some salvage value, but over a certain amount of time, this asset will lose value. And you see how I drew a straight line from the cost of the asset to what its terminal value is, okay? So this asset loses value in a straight line using the straight line method. Accelerated method is slightly different, and we use this for taxes, and then other companies use it for other reasons. But here, the situation is, actually we think this asset's going to lose a lot of value in the early years of its life, and then it'll kind of shallow out towards the end of its life. So the curve here would look like this, where the asset loses a lot of value in the early part of its life, but then in the future, each year that goes by, it's not really losing that much value anymore. It really, have you ever heard the saying that a car loses half of its value once you drive it off the lot? Okay, that's implying some sort of accelerated depreciation, where the value really goes down a lot in the early part of owning that asset. So that's what the kind of the plot would look like if you're going to depreciate this asset using an accelerated method. Finally, variable rate, and you can probably guess what this plot's going to look like, but you have a starting value and an ending value, and over time you want to depreciate it, okay? Variable rate, you'll typically find this in like oil and gas companies or other resource companies, where sometimes a well, oil well or some sort of a mine will produce a lot of output, and sometimes it won't produce very much output. So the mine or the well is an asset, and to answer the question, how does it lose value over time? The answer is, well, it depends on how much we produced. Usually, that's the industries that are using this type of a rate. So if a company doesn't really produce much in the early years of a well, maybe they won't depreciate at all. But maybe one year they really produce a lot of oil or gas out of the well, then it'll lose a lot of value in that year. And then maybe the next year not so much, and the next year. So you see how this is a variable rate, and it depends on some amount that we're using this asset. So at what rate are we using up this asset? But again, variable rate, not very popular. Accelerated, not very popular. The most popular method is straight line. So that's the method we'll focus on in this class. So now we'll talk about how to actually implement the straight line depreciation method. And we'll remember the acquisition cost of this treadmill desk. Remember, we paid $350 for this desk. Now accountants jump in and they make estimates. So the first estimate is useful life. How long will we be able to use this treadmill desk? The estimate is 3 years. They could have come up with a different estimate. They might change this estimate in the future. But as of the acquisition date, we think this thing is going to last 3 years before it goes up in smoke, okay? And the second thing we're estimating is its salvage value. So once it does go up in smoke, can we find some sort of a buyer somewhere to buy it, and what amount will they pay for it? And so the estimate is, at the end of 3 years, we're going to be able to sell this thing to somebody for $50. Okay, they're just going to pay $50 for it in 3 years. So what we'll do now is depreciate this asset value. Right now it's starting at $350. We'll depreciate it over 3 years to $50 in a straight line. So how do we calculate annual straight line depreciation expense? Well, we take the acquisition cost, $350. We subtract the salvage value, and that's going to be a numerator. So the numerator represents the total amount of cost that we want to depreciate. The denominator is how many years do you have? And that's the useful life. So we're going to depreciate $300 worth of value over 3 years. And you'll come up with, so 350 minus 50 is 300, divided by 3 is $100. So we'll depreciate $100 per year for this treadmill desk. And at the end of the year, it'll be at $50, its salvage value. And here's how that looks. So at acquisition date, we're going to debit PP&E, the asset account, for $350, credit cash for $350. Now, after 1 year goes by, we've had 1 year of use on this treadmill desk, we'll debit an income statement account called depreciation expense, and there's for that $100 that we computed. And we'll credit a contra asset account, so that's what XA stands for here, contra asset account, for $100 accumulated depreciation. So what is the deal with this contra asset account? Well, on your balance sheet, when we report the balance sheet, we don't just report PP&E alone. We have a contra asset that goes along with it. So let's think about the end of the first year. We want the book value of this asset not to be $350, because we want it to have lost $100 worth of value. So it needs to be down to $250. So we stick this accumulated depreciation contra asset account up in the balance sheet right next to the PP&E account to reduce the value of PP&E to its net book value. Okay, so that's what the accumulated depreciation account is for, and it's holding a credit balance. And since this is straight line depreciation, this first year journal entry just gets repeated for every year during the useful life of this asset. So each year we'll debit depreciation expense and credit accumulated depreciation for $100. This depreciation expense will show up in the income statement every year. And this accumulated depreciation account will accumulate the depreciation. So it'll start at 100, go to 200, go to 300. And I'm going to show you what that looks like now. So here's what the balance sheet looks like for these 3 years. Here's the balance sheet in the non-current asset section of the balance sheet. Okay, you have the PP&E accounts. You have PP&E, which is the gross account. So I'll put gross. Gross just means we're not reducing it by anything. Okay, and so this amount stays at its acquisition cost, but this accumulated depreciation account is a contra asset account, and it's just sticking to the bottom of the PP&E account, so that when we show it on the balance sheet, its net book value actually does reduce over time. So you can see this, the PP&E account stays consistent over the 3 years, but accumulated depreciation accumulates $100 every year. And so the net book value of this asset decreases by $100 every year. And by the end of 3 years, you can see that we've reduced the value of the asset to $50 on our balance sheet, exactly as planned. Okay, here's what the income statement looks like over those 3 years. We have depreciation expense, just a normal expense account on the income statement, and we're seeing $100 every year. And remember, these income statement accounts, they get closed out to retained earnings at the end of every year. So $100 the first year, closed out to retained earnings. Then a new $100 the second year, closed out to retained earnings. And the final $100 in the third year gets closed out to retained earnings. So we're just reducing net income by $100 per year. Okay, now we'll talk about the impairment of PP&E. So let's talk about the end of the first year. The acquisition cost was $350. We've got accumulated $100 worth of depreciation. And so our net book value at the end of the first year is $250. And now we're at the end of an accounting period. And we need to do any adjusting entries that are required before we show this balance sheet to investors. We need to do an impairment analysis over the PP&E balance. So the question is, do we need to impair this book value? Is it fair for us to tell investors we have an asset worth $250? Well, what if the treadmill desk has gone up in smoke and is not working anymore? Is it fair to tell investors we have a $250 asset? No, it wouldn't be fair in that case. So we need to do an impairment analysis. Here's how the impairment analysis is done. It's called a two-step impairment test, okay? So here's step 1, and here's step 2. There's 2 different step 2s, okay? Step 1 is first you create a schedule of expected future cash flows that the company is going to be able to generate using that asset. So how much money is this treadmill desk going to generate for our company in the future? Okay, you just create a schedule showing the total cash inflows you think you're going to expect to have thanks to the fact that you have this treadmill desk. That's step 1, this undiscounted expected cash flows. Then you compare the undiscounted cash flows to the book value of the asset. Remember, the book value is this $250. So is this treadmill desk going to generate cash flows to justify its $250 book value? Yes or no? If the undiscounted cash flows is less than the book value, so if these cash flows do not justify the book value, then you need to record an impairment to the asset's fair value. If the cash flows are enough to justify the book value, then you don't need to record an impairment. You can just stop there. So let's implement this in practice. We'll talk about the treadmill desk. It's got a book value of $250. And as of December 31st, 2020, what the accountants need to do, they need to decide how much extra cash will our company generate because we have this treadmill desk. And let's say this is the schedule we prepare. Well, next year I think it's going to generate $100, the year after $100, and the year after $100. So it's going to generate a total of $300 over the next 3 years. So this is going to be a really useful asset to have, okay? This person here, this guy is going to be much more productive when he's walking on a treadmill desk than he would be sitting in a chair. So that's the reason that this treadmill desk has value. So $300 of undiscounted cash flows, we compare that to book value. And since 300 is greater than 250, okay, this is step one. This implies that we do not need to record an impairment. Okay, the undiscounted cash flows are enough to justify the book value of $250. Okay, now let's do a different scenario. Let's suppose that after 1 year, we actually think this treadmill desk is going to light on fire and it's not going to be around anymore. So actually, we're only going to generate these extra cash flows for 1 year, and that would mean a total of, this is a total of $100 of total future cash flows that this thing's going to generate. Well, unfortunately, 100 is less than 250. Okay, so step one did not turn out well for this treadmill desk. The undiscounted cash flows are lower than its book value. So now we need to proceed to step two, which, remember, we need to compute the fair value of this asset and then write it down. So how do we compute the fair value? Well, we discount these cash flows. So $100 a year from now is actually not worth $100 today. So we compute the fair value of this $100 by discounting. And let's just assume we use like a 10% discount rate, and we come up with the idea that today those future cash flows is worth $90, okay? So this is today's value of that treadmill desk. What we'll do is we'll write down the treadmill desk to that value. So we'll record, so the current book value is $250. We think the fair value of the treadmill desk is $90 because it's only going to produce $100 of cash flow a year from now. So we'll write down the value of the treadmill desk. We'll record depreciation expense for $160. $160 reduces the $250 down to $90. And we'll increase our accumulated depreciation account by another $160. Okay, that reduces the value of the asset on the balance sheet. So now after we record this impairment, let me show you what the balance sheet looks like. We still have the acquisition cost of $350, but now we had to record, extra, you could think of it as extra depreciation expense. We've got this large accumulated depreciation balance offsetting its acquisition cost, and we've reduced the net book value of PP&E down to its fair value, okay? And that's the two-step impairment test. Finally, we'll talk about disposal of an asset. So you can see I've reversed out the impairment. Everything's going fine with the treadmill desk. We're 1 year into it, so we've depreciated the desk by $100. It's got a current book value of $250. Well, the guy doesn't like it anymore, okay? He's not using it. We're gonna sell it to somebody else at the end of this first year. So we're gonna sell this asset, and I'll show you how we do that in two different ways. So the question is, how much money can we get for this treadmill desk when we sell it? And that'll determine whether we have a gain or a loss on the sale. So suppose we sell this asset here for $500, okay? We're gonna get $500 in cash. And the next thing we need to do is we need to remove all traces of this asset from our balance sheet, okay? So we need to remove its acquisition cost, which was $350. We also need to remove that accumulated depreciation balance of $100. And remember, the accumulated depreciation account, it was a credit balance, so to remove it, we debit accumulated depreciation. The PP&E balance was a debit, so to remove it, we record a credit, okay? So these two parts of the journal entry here, these just totally eliminate the treadmill desk from our balance sheet. It's now no longer on our balance sheet. In its place, we've got $500 of cash. And as you can see, this journal entry is not balancing. 500 plus 100 is 600, which is more than 350. So to balance this journal entry, you either have a gain or a loss. In this case, we need a credit to balance this journal entry. And the credit goes to the income statement. And when you put a credit on the income statement, it's just called a gain, okay? So I'm just gonna call this a gain. It's a non-operating gain on our income statement. It will increase net income. It's a credit to this account for $250. And the reason you had to do it was you needed to balance this journal entry so that each side of the journal entry has the same amount on it, $600. So in this case, when you sell it for more than its book value, you record a gain. Here, we're gonna sell it for $200, which, as you'll remember, book value is $250. So this $200 is less than its book value. So we're gonna have a loss. We'll debit cash for $200 for the cash we receive. We'll eliminate all traces of this asset from our balance sheet the same way we did before. But this time, to balance the journal entry, you'll see that we need another debit of $50 to balance this journal entry. And the debit is going to be to the income statement. And when you put a debit on the income statement, that's just called a loss, okay? And it's a non-operating loss. So it'll go in some non-operating section of the income statement. And so that loss is in the amount of $50, and it shows up in the income statement, reducing net income. Now, let me just go over the T accounts as the last item for this video. PP&E is a asset account. Okay, this is the asset account. It's in the non-current section of the balance sheet. Since it's an asset, it has a normal balance of a debit, so its beginning balance is a debit. When we purchase new PP&E, we'll debit PP&E, and let's just say we credit cash perhaps, okay? So the debit to PP&E is right there, purchases, increasing the PP&E account. And when we dispose of any PP&E, whatever the gross book value of that PP&E that we're disposing of, we take that out of the T account. Okay, so that's a credit in the PP&E T account. And finally, you get to an ending balance, which will still be in the debit position. And by the way, this gross value of disposed PP&E, you see how that's a credit in the PP&E T account? Well, let me show you these prior journal entries. Here it is. Here's that credit right here, the credit to the PP&E T account. Okay, so next, let me show you the accumulated depreciation T account. Accumulated depreciation is a contra asset, so it's in the asset section of the balance sheet, but it's contra, which means it has a normal credit balance. So its beginning balance is a credit. When we record new depreciation expense, we debit depreciation expense and credit accumulated depreciation. So there's the credit to accumulated depreciation. When we record impairments to PP&E, it's the same journal entry as depreciation. It's a debit to depreciation expense and a credit to accumulated depreciation for impairments. And finally, the accumulated depreciation of disposed PP&E, that's a debit, because that's when we remove the accumulated depreciation associated with that asset. So you see this debit in the accumulated depreciation T account. I'm going to go back to that journal entry now. Here's the debit right here to the accumulated depreciation T account when we dispose of equipment. Okay, so that's what this debit represents. And finally, you'll get to an ending balance in this T account, which is also a credit balance since it's a contra asset. Okay, just to recap, we talked about a lot in this video. We talked about what is a long-lived asset. A long-lived asset has material value and a useful life greater than 1 year. We talked about for finite-lived assets, we need to record depreciation expense. And depreciation expense is just the systematic recognition of the asset's cost into the income statement over its useful life, okay? And in particular, we learned about straight-line depreciation, how to calculate that. Next, we learned about the two-step impairment test, where you first make a list of cash flows. What are the undiscounted cash flows? Are they enough to justify the book value? If yes, then no impairment. If no, then impair the asset value to its fair value. And finally, we learned about disposal. So when you dispose of an asset, you debit cash for how much you get for it. You credit PP&E to get rid of the PP&E balance. You debit accumulated depreciation to get rid of its accumulated depreciation balance. And whatever you need to balance the journal entry. If you need a credit, then that's going to be a gain on sale. If you need a debit to balance that journal entry, it's going to be a loss on sale. So you recognize that gain or loss in the income statement.